I'm Mara,
I'm Amy.
and we're covering financials and real estate.
So first one we're going to talk about is financial sector. We have it weighted as 11.5 in our portfolio, which is what the estimated S&P 500 is going to be, but currently it's 14.65.
So financials in the past 5 years. So it's the blue line, and then the S&P 500 is the green line. And as you can see, they've kind of been like chasing each other up and down. And we've been performing higher than the S&P 500 since 2017.
And financials is a cyclical sector, so when the economy does worse, financials will do worse as well. So in the financial sector, there are 7 industries: banks, thrift and mortgage finance, diversified financial services, consumer finance, insurance, mortgage real estate investment trust, one of the REITs, and capital markets. Of these 7, we have 2 of them, banks and insurance, the very simplest ones to explain. Our financial stocks of banks, we have Cullen Frost Bankers, SunTrust Banks, and then insurance we have Universal Holdings. We also have another stock in our financial sector, and that's what we talked about. It's just to give money into the sector to weight it correctly compared to the rest of the S&P 500. So, we'll give a look.
So Cullen Frost Bankers, they're located in Texas. They have a target price of $98.47 or $98.47. And then their current price is higher at $103.84. They're mature with stable growth. Most of these are pretty mature since it's harder to enter into this industry, and it's cyclical again because it does better when the economy does better. So SunTrust Banks, they're a super regional bank holding company. They operate in Florida, Georgia, North Carolina, all the states located on there. They also have a target price of $68.93. Their current price is lower at $66.17. And then Universal Insurance Holdings, they're located in Florida, and they have a lower target price than their current price as well, at $31.01. They're also mature.
And we have the target price and the current price because we talked about the other day how if it's too high, it might be overvalued, and so the price could be coming down again soon, or if it's too low, it might not be performing as well. So it's just something that we'll need to track our stocks to make sure that we're setting the proper target price for it, and whether we should change our amount of them. So some special metrics that are used in the financial industries is the PE ratio, of course, but then also the PB. It's the market price divided by the book value. Both ratios tend to be higher for banks, showing high growth, low risk, and high payouts, which is just really nice when looking at companies. We also look at capital ratios, seeing how much capital a bank has, how much they have in stock to be able to do loans.
So other financial stocks are 2 other banks that we looked at were BB&T Corp and Regions Financial Corp, and then another insurance company that compares to ours is Progressive Corp.
So in the industry, the Porter's Five Forces new entrance is really low because there's a lot of licensing that needs to happen, especially for banks, and it's really high, like front-ended cost of trying to start up a bank. You need a high amount of capital to get going. Buyers have about medium power because you're dealing a lot with long-term finance, large volumes, but also multiple options, which gives them a little bit higher than something you don't have to care about, but there are high switching costs when going between banks, so it kind of keeps buyers where they started at. Suppliers are really high threat because as interest rates change, economic outlooks change, and valuations especially, people might not be as willing to take out loans or unable to with a certain amount of interest rates.
Buyers are also like depositors and people who deposit money, so when they have more, like when the industry or when the economy is doing good.
There's more money.
Yeah.
Substitutes are really low. There's not a lot of options for banks. You go to a bank to put money in and take money out, and aside from putting it in your mattress, there's really no other place to go. So there's not a big substitute in banking. Even with insurance, that's more deals into existing rivalry because it's still the same thing. You can't not have insurance. So that's one of the highest things that banks have to deal with is the existing rivalry already. There are arguably too many players of the same size that are all competing with each other with very similar strategies. There's not very much product diversity. Get a loan here, get a loan there. Maybe just the interest rates will be different in what you do, but it's all very similar. And there's extremely high barriers to exit. You can't just decide to quit being a bank one day and hand everyone their money over and cut off mortgages, so it's hard to get out.
So, some risks and trends. Risks are definitely some interest rates and inflation because when there are higher interest rates, people are less willing to take out loans. Also government regulation and supervision, and another, part of that is a bank maybe not being able to reach the standards that they need to meet. So they have tier 1 and tier 2 capital. So tier 1 capital has to make up 6% of their capital, or of their, like, they need to have like 8% of their capital, and tier 1 has to make up 6%, so that's common stock and retained earnings. And then tier 2 is risk-weighted assets, and that has to make up 1.5%, and then other could be like preferred stock. So not being able to meet that, and then also the only way to really forecast, another risk is that the management and risk management relies on forecasting and kind of making estimates based on history or based on what they think it'll look like. And then some of the trends are based off of recent tax breaks and new tariffs. Customers are moving more towards mobile banking, so that's taking away less cash and less card payments. People are like paying with their phone and doing banking on their phone. And also recently the EMV chip readers, places can get fined if they don't have the chip readers in because it's easier to it's less secure without them. So
Our next finance sector is real estate. We have 14%. There's a 4.2% weighting of real estate in our SIF portfolio, and it is 2.75 right now on the S&P 500 weighting.
So, in the past 5 years, again, here's the chart, we have been performing lower than the S&P 500. Actually, no 5-year data was available.
It was weird trying to find it because it started between 15 and 16, and it was a little confusing on how to get some of the data, especially with it being so low.
So the real estate sector was not considered a separate sector. It was part of finance until 2016. So that's why we have data that starts in 2016. So what did it, comment on the trends from 2016 on, what did you say?
It's been pretty flat, or
Yeah.
it goes up and down obviously, but it's been pretty stable, down low. It hasn't been growing.
Okay.
So the real estate industries, there's really only two. There's the Equity Real Estate Investment Trust, REIT, and Real Estate Management and Development. We have two stocks, and they're both in equity.
So our real estate stocks are Crown Castle International Corp. And Avalon Bay Communities. Crown Castle is a REIT that owns, operates, and leases towers for wireless communications. I would have thought that they would be like, I don't know, I wouldn't expect them to be towers. See, their target price is at $105 and their current price is at $110.41. Again, like the banks, they're cyclical and most of them have mature, stable growth, and that's what these two have. Avalon Bay Communities, they make community multifamily properties, and they specialize in upscale markets such as Boston, Los Angeles, New York City, and San Francisco. And their target price is at $194, and their current price is at $179.
So some special metrics for real estate. We did already talk about this in another presentation, but it's the funds from Operation FFO and also the adjusted funds for Operation AFFO. I thought it was worth including again because they matter so much to real estate. Putting depreciation back in, because while you depreciate on your books for a building, if you still have it, it still matters, and it's important in trying to evaluate the company. Another one though is occupancy ratio. When dealing with real estate that's more like Avalon Bay Communities where people are living in them, you need to know how many people are actually utilizing the space that you have. In Crown Corp, where there's cell phone towers, arguably occupancy rate would be how many different companies are using that tower, but it would also depend if that one tower is only for one type of cell phone company. So with that specific company, the occupancy ratio would likely not be very helpful. So some other real estate stocks, just to give an example of another equity REIT, is American Tower Corp. They also do telephone towers, and we have those in our REIT fund with SIF, and Real Estate Management and Development, Equity Residential.
So, industry competition. The threat of new entrants is medium because, again, there's high startup costs. It's kind of a harder industry to enter. You need land, you need, you need a lot of capital. The buyer's power is high because you need to know, or you need to build something that someone wants. You need to have property or product or land that someone wants. The suppliers is medium to high because you need to have land. Like, you can't just get land from anywhere. You need to, I don't know, there's only so much, there's only so many, like, supplies and equipment for that. And then the threat of substitutes is low because the types of real estate change, but people are always going to need to have like the cell phone tower or land or a new building. And then the existing rivalry is high because there's a lot of different companies within the industry that compete with them.
There's also a really high exit cost within real estate as well, because it's, again, if you have a giant building, if you're renting it out to a bunch of people, it's really hard to just decide that you're done. You have to find someone who wants to buy that from you, or you have to somehow kick all these people out of whatever it is that you own and renting, and then you would have to demolish it or like leave it where it is, and that's not very profitable either if you're trying to get out in the green. So existing rival is really high.
So the risks and trends, some of the risks of investing in the real estate and just a REIT is that companies might abandon projects that they've started, so they might not be able to finish it, they might not have the resources to finish it. Also, that occupancy rates and rents might fail to meet your expectations. Another risk is the liabilities due to tenants or leaseholders. They might not take care of the apartment or the land or the building the way that they would be expected to. And then also, like natural disasters in the area. And then, for the trends, there's a large trend out for people working at home and not working in an office. Newer cell phone towers, robotic construction with less human labor, eco-friendly buildings. People are getting LEED certificates, so like leadership in energy and environmental design. And then reducing or removing asbestos, which is,
Yeah, it's pretty bad for your health. They're even doing it up on campus in the MBS building. They had to go through a lot of trying to remove the asbestos. Asbestos was a type of insulation that was used a lot, and then they kind of found that breathing it in too much really killed you. So they're trying to take that out of a lot of residential buildings. So, thanks. Any questions?
Could you go back to your, do you have a question, Joe?
I had a question section. That insurance company, Universal, where in Florida are they located? Are they in Miami, Orlando? Are they gonna essentially, if more hurricanes hit and start trying to sink Miami, are they gonna have to pay out a crap load of money to try and rebuild a city that's located like 10 feet above sea level? Are they a good place to trying to have in a portfolio over the next 5 years?
That is a really excellent question that we will have to evaluate to see if a lot of their insurance holders are in danger.
Midwest and Florida mainly, but they extended to New York, and so they're all East Coast. And yes, it's a good company because they already know that those hurricanes are coming in, so everything's in the price.
Okay.
So JP was the one who originally pitched that stock.
Oh,
So
was
if
he?
you have questions about that holding, you can ask
From the
JP.
fight.
And I'll tell you, because I actually was raised in Florida, that if you looked at the distribution of where hurricanes hit, you're probably, you're not especially better off to be in Miami versus anywhere else along the east coast of Florida. So geographic concentration in the state unfortunately won't give you a better answer on whether this is a good company or not.
Okay.
Did you have another question? Or that was
Actually, just about the asbestos. The EPA recently changed their regulations on that. Our company is gonna stop removing it now. Is that something, now that it's okay to use it in building materials again?
Interesting.
Yeah.
That is.
Yes, as of like 2 months ago. It's now okay.
Yay.
It became less deadly, I guess.
So you correct, yeah. So
We're
quality of building
evolving.
supplies.
So we'll be eating it for breakfast.
That rate, I'm not gonna touch, I don't really into that. Okay, could you guys get to the chart with your first chart with the industry performance for the banks or financial sector relative to S&P? Okay, this is just a question for fun. Just looking at this chart, would you say the beta for the finance sector overall is higher or lower, or is it higher or lower than 1? Do you remember what beta tells you?
Not on the spot.
it's like right around 1 or a little bit over.
So I think it'd be, I think it'd be
Close to
closer. Looks
1.
pretty volatile. Yeah.
Okay, who in this class remembers what beta tells you? Charles?
Oh, yeah.
Oh,
What'd
John?
you say? Yeah, the volatility of it, how much it'll change.
Comparing 1 unit
comparing to
change, so if it's like.
1
over
unit change in what? 1 unit change in?
Dollar amount?
Baseline, S&P.
Okay, we're gonna play Mad Libs here. For every 1 unit change in,
S&P 500.
yeah, in this case, we'll use the S&P 500, but the market, which oftentimes you'll see the S&P 500 used as a proxy for the market. you'll expect a X unit change in a stock or a sector. And so if that's a 1 unit change, then the beta will be 1. If the market moves 10% and you expect the financial sector to move 20%, then it would have a beta of 2. So a higher beta equals more volatile, right? So just looking at this chart, what would you say?
I would say it's more volatile.
Yeah, like the lows are lower, the highs are higher, but otherwise it tracks the S&P 500 pretty closely,
Yeah.
right?
Yeah.
So that's why I asked you that question. So we only hold commercial banks and then an insurance company in the finance sector. Were there any of those other, wait, go back up one. Were there any of those other sub-industries or industries that you thought might be worthy of inclusion in our portfolio or interesting?
Maybe consumer finance.
So what's the difference between consumer finance and banks?
So it's kind of confusing because they're all really similar, I feel like, but consumer finance is more like it's more like people who aren't going to a bank to store their money, but is it to get a loan, like more people?
So consumer finance, so if you had a defining characteristic of banks, it's usually organizations that take deposits, right? So you can have like a checking or savings account at a bank. Consumer finance companies might be like payday lenders or like credit companies that issue. So you guys have seen that Visa is one of our holdings in our portfolio, but it's actually in the technology sector. But other kind of payment processors, some of them might end up in this category because it's a little bit murky, that division. This is another industry where I think oftentimes, like, we've focused in primarily on banks. You guys mentioned it because they're the easiest to understand of the sector. And I'm okay with that because I don't want you guys trying to invest in something you absolutely don't understand. But I do like to push students a little bit to maybe explore outside of this comfort zone because within banks there are more complicated banks and less complicated banks, and we keep on investing in super simple banks just because that's what we can get our head around, and people get so excited that they can understand a bank that they buy it. So that'll be you guys' challenge this semester, is to maybe look outside of banks. And I'll share, so my REIT guys, what's the difference between a mortgage REIT and then the equity REITs? I won't make these ladies answer that. Make you answer it, or JP if he wants to come join us.
So the question is, difference between a mortgage REIT and an equity
Yeah.
REIT?
Yeah.
So the mortgage REIT is based on the liabilities, and so this is traded in between REITs company. Am I right by saying that?
I didn't really understand what you were saying.
So mortgage REITs are mortgages that REITs can use as a liability and debt, and so this is how they deal when they want to. Am I right? Because you look at me in a weird way.
Yeah,
But
I think
mortgage-
we might be having a language barrier here.
Maybe not.
Okay, do you want to take a stab at it?
In kind of simpler terms, an equity REIT is basically a company that would buy some kind of properties or whatever and then lease them back. So it's kind of based on more rental income more than anything. A mortgage REIT is more based on the debt of an actual mortgage. So when you buy a house, you have to get a mortgage, which is a loan on a house. And so it's kind of based on getting money from the actual mortgage itself, rather getting money than from the rental.
We have some good guesses here.
Mortgage REITs are tradable. Equity REITs are what the company holds. Can I say that? I'm sure I can. I'm sure I can.
Okay, I'll put it this way. So equity REITs own the properties that they're renting out, right? They have equity in them. That's what it means to have equity. Okay, so they hold equity. That's why they're called equity REITs. Because these are all stocks, so they're all equities, right? But forget that for a minute. Mortgage REITs don't own the business, don't own the buildings. They lend significant amounts of debt to these big buildings, and they're still classified as a REIT. They just don't own them. They're a lender to, a real estate lender. So it's different, but it's still under the legal form of a REIT. Does that make sense, you guys?
Yeah, and not only for housing or apartment or building, you can do that also with different companies that are also working for maintenance or security in REITs. Because they have that little twist you can do, because if you would have like a maintenance company that is working underneath the REIT, well then according to the old laws, it would have been illegal to have the statute of a REIT because you would have shares in a maintenance company. But now they do that on a company that would offer their maintenance services.
You're talking about the like UPREIT, like umbrella
Yeah,
structures.
yeah.
I wouldn't get too complicated than that. Just know that our REIT portfolio is all equity REITs, and I think according to our bylaws, has to be all equity REITs. Mortgage REITs are harder to analyze because they don't actually own the property. They're essentially like, think of them as a very specialized lender that only lends to big real estate projects. And because they're also classified as a REIT, they still meet all the other requirements of REITs, like paying out dividends, et cetera, et cetera. Okay, but they're, unless you guys are really interested in credit analysis and learning all about debt, which is a whole nother can of worms, I'd probably.
Quite fascinating,
that
by the way.
one. Yeah.
Don't buy REIT, guys. We're in charge of this. I don't want you to
Okay.
pitch for well while I'm going to pitch for well. I'll tell it.
Okay.
Hey.
That's my next pitch.